Welcome everyone. Today, I'm excited to introduce you to the Advanced Smart Money Concept Framework. We'll explore how this innovative approach is designed to optimize risk and reward, enabling precise institutional entries. This presentation will cover advanced trading strategies tailored for Forex, crypto, and CFD markets, focusing on identifying institutional footprints for high-reward trades. We'll delve into techniques like liquidity sweep and order block strategies that help us execute with unparalleled accuracy. Let's get started and discover how this framework can elevate your trading game. These stop hunts are really the fuel that powers major institutional movements in the market. What I mean is, institutions use these sweeping moves to gather the liquidity they need. This creates the perfect environment for them to kick off their large, directional trades. Now, these sweeps are not random, they are targeted. Usually, they aim for areas where retail traders have placed their stop losses, like at clear highs or lows, or previous significant swing levels on the chart. These are key levels where retail traders are vulnerable. So, a liquidity sweep happens when price temporarily pushes beyond a support or resistance level. This move is designed to trigger retail stop losses, clearing the way for bigger moves. And this process is often called hunting stop losses. It's a strategic move by the big players to collect liquidity and set up their next big move. Understanding this is crucial because it explains a lot about why the market moves the way it does, especially around those key levels. These zones are really crucial because they act like footprints left by institutions. Think of them as signposts, indicating potential future entry points when the price comes back to these levels. It's like leaving a trail for us to follow. They can function as either a supply zone, which is bearish, or a demand zone, which is bullish. Basically, these are areas where large orders were placed, either selling heavily or buying strongly. Now, an order block, or OB, is defined as the last opposing candle before a strong, impulsive move in price. This move shows us that there's significant institutional interest behind it. When we see an order block, we're essentially spotting where big players have entered or exited the market, giving us clues about future price action. Understanding these order blocks helps us identify potential turning points and better anticipate market moves, which ties directly into our overall strategy of reading institutional behavior. Now, let's focus on how the combination of a liquidity sweep followed by a return to an order block creates a high risk-reward zone for entries. Essentially, when a liquidity sweep happens, it clears out retail stop orders and draws in liquidity, often on the wrong side of the market. After this sweep, the price reverses and returns to the previously identified order block zone. This is a critical point because institutions tend to execute their precise trades within this order block, leveraging the liquidity that's now been acquired. This synergy between the liquidity sweep and the return to the order block is what makes these zones so attractive for high-probability trades. It's a setup where the risk is limited, but the potential reward is significant, especially considering how institutions operate within these zones. Understanding this dynamic helps us better anticipate potential reversals and make smarter trading decisions. A high-quality order block can really boost the reliability of your entry, making it more likely to succeed. It's crucial to ensure that the order block aligns with the prevailing higher time frame trend, because this alignment increases the probability of a successful trade. If you're trading against the trend, your chances diminish, so always check that your OB is in harmony with the larger trend context. Next, avoid zones that are cluttered with minor or previously mitigated order blocks. These areas tend to show weaker institutional interest, which makes them less reliable for entries. You want to focus on zones where institutional players are actively involved, not zones that have been exhausted or ignored. Also, pay attention to the candles preceding the impulsive move away from the order block. That candle should be well-defined and distinct. This signals a clear shift in momentum. A strong, impulsive candle indicates that the move is genuine, not just noise or a false signal. Look for a clear break of structure, or BOS, because that's a key sign of a shift in market sentiment and momentum. When you see a strong BOS, it confirms that the previous market structure is broken and a new trend may be beginning. Remember, not all order blocks are equally reliable. Focus on these key criteria: the alignment with the HTF trend, the clean impulsive candles, and confirmed BOS, to identify high-probability entry points. This approach helps you trade more confidently and increases your chances of success. Now, let's talk about setting your stop-loss strategically. It's important to place your SL beyond the order block or the liquidity extreme of the sweep. This way, you're giving your trade room to breathe if the market moves slightly against you, while still protecting your capital. Moving on to placing your stop-loss, I recommend doing this on a lower time frame, or LTF. Look for a rejection candle or a market structure shift, known as an MSS. These are your clues for a more precise entry point. By focusing on these signals, you increase the probability of entering at a more favorable location. Next, be patient and wait for the price to retrace after a sweep. Specifically, look for it to return into the identified order block zone. That's where the real setup occurs. This retracement confirms that the market respects the order block and that the move is likely to continue in your favor. While waiting, observe the price action carefully. Watch for liquidity sweeps of equal highs or lows, or significant liquidity pools near your order block. These liquidity zones can often trigger the move or provide additional confirmation that your setup is valid. Once you've identified potential order block zones, it's crucial to analyze the higher time frames, like the daily or 4-hour charts. This helps you understand the overall market bias and ensures your setup aligns with the larger trend. Bringing it all together, this step-by-step process helps you build a solid trade setup. By understanding the bigger picture and confirming your entries on lower time frames, you increase your chances of success. Remember, patience and proper placement of your stop-loss are key to managing risk effectively while maximizing your potential reward. Let's talk about the importance of precision execution on the LTF, or lower time frame. By honing in on our entries with accuracy, we can significantly reduce our initial drawdown and improve our risk-reward ratio. This means more efficient trades and better overall performance. Now, an optional but highly effective confirmation to consider is whether the entry aligns with a fair value gap within the order block zone. This confluence adds an extra layer of confidence and helps us pinpoint optimal entry points. Moving on to confluences with the FVG, or fair value gap, one key signal is a long wick, which indicates a strong rejection of a particular price level. You'll often see this at the edges of an order block, signaling that a level is being defended by the market. This rejection wick, sometimes called a pin bar, is powerful because it shows that buyers or sellers stepped in strongly, pushing the price away from that level. Recognizing these can give us early clues about potential reversals. Next, let's consider the bullish or bearish engulfing pattern. When a candle completely engulfs the previous one, it signals powerful momentum in that direction. This pattern often marks a shift in market sentiment and can be a great confirmation for entries. Finally, keep an eye out for a short-term trend change on lower time frames, known as the LTF market structure shift, or MSS. Detecting this shift indicates that a reversal from the liquidity sweep is underway, giving us a valuable signal to refine our entries. All of these confirmations, whether it's the FVG alignment, rejection wicks, engulfing candles, or market structure shifts, are tools to help us refine our entries. Using them together allows us to minimize drawdown and increase our chances of success in every trade. Let's talk about setting your risk-reward ratio. Ideally, aim for a minimum of 1-2, meaning for every dollar you risk, you want to aim to make at least 2. But if you can push that target to 1-3 or higher, you'll be in a much better position to ensure profitability over time. When you're planning for extended targets, look towards the next higher time frame point of interest or a major liquidity zone. These areas often serve as natural turning points in the market. Now, regarding Take Profit 2, or TP2, Your goal should be to target the nearest significant previous swing high or low. Securing profits at this level helps lock in gains as the trade develops. As for Take Profit 1, or TP1, you'll want to place your stop loss strategically beyond the extreme of the order block or the liquidity sweep. This provides your trade with enough room to breathe, reducing the risk of getting stopped out prematurely due to normal market fluctuations. Finally, let's remember the key rules for stop loss and take profit. Always align your stop loss beyond a logical market level, such as an extreme of the order block or a liquidity sweep, and set your take profits at levels that make sense based on previous market structure. These principles help manage risk effectively while giving your trade room to develop. Let's talk about some common pitfalls that can really hinder your trading success. First, patience, discipline, and strict adherence to your structured trading plan are absolutely essential if you want to achieve high accuracy. Jumping into trades impulsively or without a plan can lead to unnecessary mistakes. Next, risking too much on each trade is a big no-no. Proper risk management is critical for long-term survival in the markets. You want to protect your capital and avoid big losses that can wipe out your account. Another point is skipping lower time frame confirmation. This often leads to premature entries and increased drawdowns because you're not aligning with the smaller, more precise setups that confirm your larger trend. Trading overlapping weak order blocks can also be problematic. When the blocks are cluttered or mitigated, they signal weaker institutional interest, making them less reliable as entry points. Ignoring the higher time frame bias is another mistake. Trading against the overall trend on the bigger charts significantly reduces your chances of success, so always consider the broader trend context. Finally, entering an order block without a liquidity sweep is risky. A liquidity sweep is a key precursor for institutional entry, and without it, the order block may not hold or produce the expected move. Avoiding these pitfalls can really help you improve your trading performance and consistency over time. Now, let's talk about the importance of trading where smart money trades, leveraging institutional logic to find consistent, high-probability setups. This means understanding where the big players are active and aligning our trades with their moves. Are you risking a manageable percentage of your capital? Remember, staying within your risk management plan is crucial to protect your account and stay in the game longer. Next, consider if your stop loss and take profit levels are strategically placed. A favorable risk-reward ratio can make a huge difference in your overall profitability. Be intentional about where you set these levels, ensuring they align with the market structure and your analysis. We also want to see clear signals inside the order block, such as rejection candles or a shift in market structure on lower timeframes. This LTF confirmation helps us validate that the move is likely to continue in our favor. Another key point is whether price has swept a significant liquidity zone, like equal highs or lows, before returning to the order block. This liquidity sweep often indicates a trap, and when the market comes back to the OB, it can be a strong setup for a trade. Finding a high-quality order block is essential. Look for impulsive moves and clear break of structure. These elements tell us that there's strong institutional activity behind the move, increasing our confidence in the setup. Always confirm the higher timeframe bias. Are we in a clear bullish or bearish trend? Having this context helps us align our trades with the overall market direction, increasing our chances of success. Finally, before executing any trade, go through the high RR trade checklist. Make sure all critical elements, risk management, market structure, liquidity, and trend, are in perfect alignment. When everything checks out, you're setting yourself up for a high probability, high reward trade.